Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. So let's dive in there. Let's take a look. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in and take a look. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. That is where I dive deeper into these sectors, deeper into the individual companies, looking for potential investment opportunities, looking at the value, how undervalued the sector and company is, looking at the financials to some degree, and then obviously looking at the technicals to making sure that the herd is adding money into those companies and is lining up for a big move. Coming down, we've got energy versus the NASDAQ. What do you think? This is PSCE, the ETF, versus the NASDAQ. And I don't know why my clicker is going crazy here. Either way, we are bottoming out. Let me see if I can open a new tab there. We are bottoming out against support. We've broken out of this bottoming pattern. We've come and consolidated on top. If you look at a lot of the technical analysis charts, they consider this to be the ideal entry point on a lot of them. This is a ratio chart. It's the small cap ETF versus small cap energy ETF versus the NASDAQ. So we've got a nice little falling wedge right into support where I think we get a massive outperformance of energy versus the NASDAQ over time. Doesn't mean it'll happen immediately. It could. It could happen immediately, but it looks like a really good entry point right where we're at. Another one, XOP versus the NASDAQ as well. Very similar chart setup. We've got a bottoming pattern that basically was scribed out. We've broken to the upside, and now we've got a three-hump consolidation, falling wedge, aka flag pattern, almost back to support. And we can see that across the board in a lot of these energy stocks. Coming back to the top here, we've got OIH versus the NASDAQ as well. This is oil services versus the NASDAQ. What do you think? So when looking at this, we've got that bottoming pattern that's coming back to doing a retest. I didn't put the horizontal trend line there. And then we've got a three-hump consolidation right to the top of that support level. I think it looks absolutely fantastic. A lot of different opportunities for investments in this location right now. On the website, I've dived into a lot of the energy service sector and the exploration production sector of oil, nat gas, and energy services. I think I've identified what I would consider to be the most leveraged balance sheets in the sectors there. So the ones with the most upside, and I'll call it asymmetry, so big upside versus its downside potential. And we have invested in those companies for this bull market. At least I have invested in those companies for this bull market. Bullish engulfing retest for the energy sector. Yes, please, for XLE. XLE is an ETF. It's a little bit larger companies. Sometimes people view this as a leader. It is also sitting on top of a very large long-term support level. So it goes all the way back. This is the shorter term of the bullish engulfing and the retest and the falling wedge that we've got in this setup here. If you look backwards, you can go all the way back to 2008, and there's a big support level all the way across. This is the retest of this on that support level going across. So we've got a potential big move ahead of us, hopefully, in energy and all energy-related equities. Canada's lowest tax jurisdiction, which is Alberta, has a higher tax rate than the United States' highest tax jurisdiction, California. No matter where top talent lives in Canada, they face a higher tax rate than they would in the US states. And I don't know how accurate that is because I don't know the Canadian tax system. I don't know if they include all of their taxes on just the income side, and if they add sales tax and all these other taxes on other portions. So I don't know if a lot of these areas are completely comparable. I live in Colorado. My federal tax on top of, well, this would be state taxes here. So this is the top personal income tax rates for an individual earning $300,000. It's 39.4%. And I don't know if that is the total taxes that Canada would see versus America. We have a bunch of taxes. We have gasoline tax. We've got cell phone taxes. We've got property taxes. We've got a whole bunch of other taxes that are all intertwined into a bunch of services and things that we buy. And I'm not sure if Canada has that as well. They might. Let me know in the comments section what if you guys also have sales tax and all these other taxes. If you add it all up, I mean, I'm sure most of us around the world probably pay something like 70 or 80% tax. The rest is actually value to buying whatever we want to purchase. Because remember, and they pay it through the sales price of those products. Lumber prices are tumbling. What I see here is a potential pattern here, and we're probably pretty close to a bottom and then an eventual move higher. So you get the big dislocation in 2020, the one hump, two hump coming through, and then the third hump. We're kind of doing this big third hump, and the eventual bottom here probably shortly. Our home price is going to yank these lumber prices up. I don't think home prices are going to crash like a great financial crash with a huge deleveraging in credit. I don't think that's in store for us. But there could be a slowdown, and maybe that's what lumber here going down is indicating, is that slowdown. When will it end? When will it turn? When will it go back up? I don't know. We'll have to watch what interest rates do and how the housing market interacts with those interest rates. Julian says, I use the Bank of America Flow Show surveys, the Flow Show surveys of professional asset managers as a contrary indicator. The latest report flags extreme inflows into tech and growth, supporting my thesis that what marks the top isn't fundamentals, it's positioning. Once everyone is long, the only way is down. And that's what he's indicating here in the tech sector. Everyone's long right now. They've all been drawn into the tech sector. And is this the potential ultimate top? I don't know. We'll see. Josh Young says, energy return on energy invested is an important consideration, which is favorable for nuclear, hydro, coal, and gas, and very unfavorable for clean solar, wind, and biomass. And what this deals with is how much energy do we put into getting this energy, and how much energy do we get back out of it? So how many barrels do we put in, and how many barrels do we get back? Or how many units of energy do we put in, and how many units of energy is available to society? Nuclear, hydro, coal, and natural gas are clear winners. Solar, wind, biomass, and solar PV are clear losers and return much lower than fossil fuels at this time. The most important part of every plan is planning on your plan, not going according to plan. So yeah, make sure that the important part of every plan is that the plan isn't going to go to plan. Peter says, energy stocks are ripping and playing catch up to the recent move higher in oil. Very encouraging as we enter peak Q3 inventory draw season. Brent positioning remains offsides, 15th percentile net length, and more pods will be stopped out this week. Better to cover early. So another energy bull. I purchased a whole bunch at this bottom here, guys. I feel quite lucky. I'm pretty long in energy. I was long in energy, and I just got longer, a whole lot longer in energy-related stocks and companies. This chart is great here, so it's a great chart. This is order book versus day rates. This illustrates what's different this time for now. Day rates increasing has been correlated with order for rigs. How and when will the gap between them fill? It says, I try to keep the minutia to a minimum, but will always love energy realists for encouraging it. So this is the global UDW day rates versus floater order book. The floater order book's the green line, and the purple line is the average floater day rate. Now, when the day rates go up and the companies release their rigs, that is when they make more money. And what we've noticed is that when day rates go up, the floater order book goes up with it. Look at on the right-hand side here, we've got the average floater day rates are going up, but the floater order book continues to decline. That is something that's different this time around. And when will this order book start to move on up? Or is this gap going to continue to grow? Something to watch. Coming back, Speedwell Research says the only companies that have created truly significant value from the dot-com era are Amazon and Google. Pretty wild stat, is that right? It says some of the companies and industries that change fast ultimately do end up creating a lot of value, but very few companies do. The only ones that have created true significant value from the dot-com era are Amazon and Google. Facebook was founded in 2004. If you want to be charitable, you could add eBay and Priceline, now called Booking Holdings. But that's it. Just step back and think about this for a moment. Only a handful of businesses from the 95 to 2000 bubble are creating significant value today. Chris says, okay, study this chart, look at it real hard. Look until your eyeballs fall out of their sockets. Material requirements per terawatt hour of electricity produced for renewables. This is crazy. So let's go over some of these stats. Solar voltaic takes 4,050 tons of concrete per terawatt hour. So everything's in terawatt hours for 1 terawatt hour. 7,900 tons of steel, 2,700 tons of glass, 850 tons of copper, 680 tons of aluminum, and 210 tons of plastic, which is more or less a derivative of oil. Hydroelectric power, 14,000 tons of concrete, 67 tons of steel, and 1 ton of copper. For wind, it's 8,000 tons of concrete, 1,800 tons of steel, 92 tons of glass, 23 tons of copper, 35 tons of aluminum, and 190 tons of plastic. In geothermal, of concrete, 3,300 tons of steel, 2 tons of copper, and 100 tons of aluminum. And that's material requirements per terawatt of electricity produced for nuclear and natural gas. 760 tons of concrete, 160 tons of steel, and 3 tons of copper. And for natural gas, it's 400 tons of concrete, 170 tons of steel, and 1 ton of aluminum. So tell me again how clean green energy really is. Mining for these raw materials would have to increase by greater than 300% to achieve net zero goals, which would make that arbitrary target date by 2050 impossible. Nuclear is by far the most efficient energy source we have, and it is the most carbon-free, and I use that term lightly, technology. Natural gas, while not carbon-free in the slightest, burns cleaner, and it's much more efficient than coal. If nuclear and natural gas aren't a part of the solution to wean us off of fossil fuels, then you, as an environmentalist, cannot be taken seriously. And what this is showing on this chart is the material requirements by energy source. Solar PV being an absolute material hog, along with hydro and wind. And that is level loading it to terawatt hours. It's putting it on equal playing field. Coal, biomass, nuclear, and natural gas are by far the winners in terms of using the least amount of materials per power generated. All right, coming on back. Coming down. When Buffett buys, you need to pay attention. Here's his buy points for Occidental Petroleum. Pretty good buy points on all of these locations here for Occidental Petroleum. And I've been buying here too in a lot of my favorite oil and gas companies. Use their income to become richer. Most people use their income to look richer. Which one are you? Are you trying to look rich or are you richer? The nuclear energy index is in a parabolic uptrend. This pattern has taken over a decade to form since governments canceled construction plans following the Fukushima nuclear disaster in 2011. A good sign for uranium demand going forward. And there's that nice parabolic move that we're going to get to the upside for nuclear energy. Silver's trading within the rising broadening wedge. It is typical for the rising trend line to be broken to form a false breakdown in a bull market. Silver could spend major part of the next week around 28.50 to whatever he put until July. Futures contracts expire until June. What I see here is a 1, 2, 3, 4, 5, 6, 7. That's a Livermore accumulation cylinder tilted upward. And then we'll get probably a massive move to the upside eventually. So I think silver looks absolutely fantastic for a move higher. We've got Christine here. She says, strong economy equals cheap energy. That's the piece of the puzzle the gas LNG bulls don't get. Gas and LNG can only fly so high as it doesn't hurt a customer's country's economy. Otherwise, that country will stay hooked on coal. And that's kind of her opinions there. And I think we're going to burn a lot more coal in a lot of countries because of how cheap it is. In order to remain competitive, some of these countries are going to have to burn a lot more coal. Another quote by Warren Buffett, he says, for the investor, a too high purchase price for a stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. So basically, you can't buy even an excellent company at an outrageous price. You got to wait until it becomes undervalued. And basically, that's just playing the bigger cycles and having those cycles to the downside, purchasing it with some sort of margin of safety and value for you as an investor. It says hybrids are outselling BEVs, battery electric vehicles, globally. Nature is healing. So we can see that battery electric vehicles since 2013 were outpacing a lot of the hybrids, and that changed here recently, perhaps, in 2023 forward. Coal and natural gas are the main energy sources used to generate electricity. Values are in terawatt hours for the year 2023. So this big gray one is coal. Orange is natural gas, and this is for the entire world, global. We've got oil here in the blue, hydroelectric here in the dark blue, and then renewables are in the green. We are approaching the levels of the 2008 crisis. Big tech is getting bigger and bigger. So the S&P 500 equal weight index divided by the S&P 500, you can see it's getting concentrated in some of these companies, but the equal weight is at lows here. So we could see some of these larger companies start to pull back on the bigger term here, I think. Getting a little overvalued. Warren Buffett says, we find doing nothing the most difficult task of all. And I think that resonates with a lot of people, that doing nothing is difficult. Everybody thinks that doing something you're improving or you're doing something that is going to better the portfolio, but most of the time all it does is jack up your portfolio and your returns, and doing nothing is most of the time the best thing to do. U.S. oil field employment is at historic lows relative to crude oil production. Bidenomics, a sign we are still early in the oil cycle, and you can see how low we are in relationship to employment and crude oil production. Is this technology getting better and more efficient, or is this indicating that we've pulled back on our drilled uncompleted wells, our rig counts are dropping, which is all true, and that this is probably a cycle bottom? Fingers crossed, because that's where I hope we're at. If that is the case, then I made some really good decisions buying some of the energy service stocks that we are in. Warren Pai says, we follow tax data. It has been strong, like the housing data. Starts, completions, units under construction. It looks more like establishment survey reality. So this is the federal income taxes withheld is increasing. We can see in the recessions that those have all rolled over in some of these darker areas. So it looks like it's still trucking higher and no recession potentially using the federal income taxes withheld data. And then we've got breaking here. The global liquidity is about to spike and will drive Bitcoin massively up, is his opinion. I'm not really into BTC. I just like the global liquidity cycle here. Now, if liquidity goes up, I think it depends on what interest rates do. And interest rates could have an impact on what Bitcoin does. But global liquidity cycle, at least according to this chart and how he's got the sine wave, could eventually turn up here. We are seeing some loosening in interest rates in some countries. So that does seem like we could be introducing another liquidity cycle at some point here, and we're a little bit underway. So it says this trend is concerning. For the first time in 4 years, the US unemployment rate has crossed above its 36-month moving average. In previous economic cycles, every time this has happened, a rapid spike in jobless rates followed. This has also coincided with the economy falling into a recession. The unemployment rate has been in an uptrend since April of 2023 and is up from 3.4 to 4%. Meanwhile, 1.5 million Americans have lost their full-time job in just 6 months. Is the labor market beginning to crack? Could we get a slowdown here? Now, some of this data suggests that we could, like this data here. And then you go up and you look at the global liquidity cycle, and that looks pretty strong. Global liquidity cycle, which is crazy that you get all these different pieces of information that are kind of conflicting with each other to some degree. They're not all, I like to call it. On down, we got. Oh, and that's where I stopped last time. So we'll stop it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys are interested in seeing how I'm playing this commodity bull market. I did make a lot of recent purchases across the board, and you can see what I did if you're a member on the website. So we do have a coupon code Mayday if you're interested. MAYDAY, one word, Mayday, if interested. So that's what we've got. We'll catch you next time. This is Finding Value.